Hello everyone, my name is Nick Macchia, publisher of Weiss Educational Services. Thank you for joining our special presentation on how to make your portfolio great again. This November 8th, one of the more polarizing elections in American political history will take place. And while many of you may be undecided about one candidate or the other, one thing is for certain. When it comes to your portfolio, it's a whole new ballgame after November 8th. This election is like hitting the reset button on the entire U.S. economy, drawing a new line in the sand for investors for the next 4 or even 8 years. While who's in the White House may not be the best predictor of future stock market returns, today's host will prepare you to profit and protect your portfolio no matter who wins on November 8th. David Frazier is President and Chief Market Strategist at Frazier & Meyer Research, a firm that provides proprietary research for hedge funds, registered investment advisors, and high net worth individuals. Over the past 17 years, David has accurately forecasted nearly all of the major turning points in the U.S. stock market, including the March 2000 to October 2002 tech stock crash, the November 2002 to October 2007 bull market, the October 11th, 2007 to March 2009 stock market collapse, and the current bull market that began on March 10th, 2009. And today, he will go into great detail about how the economy and markets have historically behaved under past Democratic and Republican presidents, how Wall Street may already be predicting the winner of this election, and the top 3 sectors and stocks for a Clinton and a Trump administration, and much, much more. Welcome, David. Nice to have you today.
Thank you, Nick. I'm happy to be here today. And you made some really poignant comments regarding this upcoming election. I don't know if you all know it, but this is a huge election. It's huge. And in my opinion and experience, by far the most important election since 1980. And the reason I say that primarily is, there's a lot of discussion and comments by so-called experts that often claim that the financial markets perform better under a Democrat president or under a Republican president. And in reality, I've done a lot of studies regarding that. And the fact of the matter is, there's no correlation whatsoever. I mean, I've gone way back to 1896, and the reason I went back to 1896 is that's when the Dow Jones Industrial Average was first introduced. And looking at how the markets performed during under every president and Congress since then, there's just no correlation whatsoever. Now, there's been periods when the stock market, let's focus on the stock market. We could talk about other markets too, the bond markets, real estate market, but the stock market, it's been periods that it's performed very well under a Republican president and very poorly. There's been periods, but it's performed very well under a Democrat president and vice versa. But without going into a lot of detail, when a particular party controls both the presidency and the Congress, there's just, stocks have generally performed well, actually, during most periods. So there's no correlation whatsoever. So, although this is a very important election, and I'll get a little bit more into that in just a moment, what really is important is what's going on in the economies around the world. I mean, that's what really affects the financial markets, is what's going on in the economy, about the U.S. economy and other primary economies around the world. And that's the reason that my firm and I focus our research on economic factors and developments. We also look at geopolitical factors, but usually those types of factors don't have any lasting impact on the markets. What really matters is what's going on in the economy and what's going to likely happen in economies around the globe 6 to 18 months into the future. And I've been very, very good, fortunately, at forecasting how economies perform and how the financial markets that relate strongly to what's going on in economies around the globe, how they perform approximately 6 to 18 months into the future. But once again, I mean, this is an important election. So let's talk about that for a moment. In regard to a Trump versus Clinton presidency, my research indicates strongly that in the event that Hillary Clinton is elected as the next U.S. President, that stock prices in general, and I'm talking about as measured by the major stock market indices, would likely move in a volatile sideways pattern with somewhat of a downward bias over the next few years. But that stocks would likely trend substantially higher over the next few years after initially pulling back sharply in the event that Trump were elected as the next president. That's primarily because my experience and research indicates very, very strongly that Clinton's economic proposals, if enacted, would have an adverse effect on the economy. I mean, let's talk about her tax proposals for a moment. For instance, the only things that she's really specifically said about any type of tax increases or decreases is that she wants supposedly to increase tax rates on persons in very high income tax brackets. So, boy, that makes a lot of sense, doesn't it? Let's make sure we increase tax rates on people that generally operate and run businesses. Do you think they're going to go out and spend more money, spend less money, whatever? That's a really bad idea. But as far as other persons in all other tax brackets, she doesn't have any proposals. She hasn't said anything specifically, and therefore we can only assume that she wants to leave tax rates where they are. She also wants to, or at least she's indicated strongly, that she believes in keeping a lot of government regulation of businesses and actually increasing government regulation of businesses. In addition, she has indicated that she wants to continue Obamacare, even though her husband, former President Bill Clinton, said recently that he thinks it's one of the craziest things that was ever implemented into law. She's probably also going to at least propose more unnecessary and wasteful U.S. military interventions around the world. That's what she's indicated. That's going to cost a lot of money. And my experience indicates really, really strongly that these are going to have very, very negative effects on the economy and therefore on the financial markets. Instead, what we really need to do is, for the most part, regarding economic proposals, what Donald Trump has proposed. And that is, he's proposing broad tax cuts, reducing taxes substantially. He's also indicated, or proposed at least, is that he would like to see less government intervention in foreign affairs. He doesn't want to see the military involved in every foreign conflict. It's very, very expensive to be involved in those conflicts. I mean, my gosh, there's been estimates that the U.S. has spent approximately $5 trillion over the past 15 years in the Middle East as a result of the Iraq War. Well, these are huge, huge proposals that are very, very important, are likely to affect the economy in a very, very positive way. I mean, let's just take a look, for example, at government regulations. Well, surely if you reduce government regulation of business, you're going to have businesses free to do a lot more things, to hire more people and to expand their businesses. My gosh, a good friend of mine that I've known for over 30 years, he told me a few months ago, he's a home builder, that he's not doing a lot of home building anymore. And the reason being, it's just the government regulations there's so much to fight against just to get approval to do building. And so he's slowed down his building of homes. So let's now look at Trump's tax proposals a little bit more specifically. And I'm not going to give you details. We might put a chart or a graph up here for you to take a look at. But if we go back to periods in the past when the type of tax proposals made by Donald Trump were implemented, were enacted by the Congress and put into law, what did we see? We saw the U.S. economy grow at very fast rates and stock prices move sharply higher. Well, first we have from 1921 to 1929 under Warren Harding and Calvin Coolidge administration, when tax rates were cut substantially. And what happened? I'm sure you've all heard of the Roaring 20s. Well, the U.S. economy started to grow at a rapid rate and did so from 1922 to 1929, and stock prices took off. Now, we had a big crash in 1929, of course, But that really had nothing to do with the tax rate cuts. That had to do with over-speculation. The next time that we had some big tax rate cuts were under a Democrat president, President John F. Kennedy. During 1962 to 1968, after the tax rate reductions were implemented by law that Kennedy had proposed, once again, the U.S. economy expanded at a rapid rate during that period, and U.S. stock prices rose sharply. And lastly, under the Reagan administration, from 1980 to 1988, Reagan had proposed tax cuts that did not actually get implemented until I think it was 1982. But then what happened between 1982 and 1988? The U.S. economy expanded at a very high rate. There was a lot of job growth, and stock prices took off. Well, why should we expect any different going forward? You know, Clinton's tax proposals, I mean, this is huge. They don't make any sense, okay? But and Trump's proposals make perfect sense. Now, I know there's been discussion and claims that, well, yes, but Mr. Trump's tax rate proposals is going to increase the debt a lot more. Well, that's a totally separate discussion. And really what's, as far as making forecast of that, there's something that's called a static forecasting. It's assuming there's no growth in the economy. If you use actual dynamic forecasting techniques to account for growth, you know, none of the things that are being said is correct. Once again, this is not about whether or not I favor on a political ideology, Ms. Clinton or Mr. Trump. It's how their economic proposals are likely to affect the markets. Okay, so it's pretty obvious that my opinion is that the U.S. economy is going to perform well and that stock prices in general are going to perform well if Trump is elected. But what's going to happen if Ms. Clinton's elected? You know, we need to prepare for that. We don't know which candidate's going to be elected. And my research indicates that certain sectors and stocks will perform better than other stocks if Ms. Clinton is elected. And let's talk about for a moment what I referred to a few minutes ago regarding Ms. Clinton's hawkish stance regarding use of the U.S. military in foreign affairs. Well, if we do see a continuation of a lot of intervention by the U.S. military abroad, we're probably going to see certain defense contractors, such as Lockheed Martin, probably going to perform better than at least most other stocks. Regarding Ms. Clinton's proposals or suggestions that she would like to see a continuation of the Affordable Care Act, that is, you know, commonly referred to as Obamacare. Well, it's very likely certain healthcare stocks are going to perform better than other stocks. One example would be HCA Holdings, symbols HCA. Another idea would be Tenet Healthcare. And then we can move on to Ms. Clinton's thinking and proposals regarding climate change and her belief, and a lot of people's belief, that climate change is a very big issue. Well, it's a good chance that Ms. Clinton is going to make proposals to increase the use of alternative energy. And therefore, certain stocks such as SunPower and Solar City may perform better than other stocks under a Clinton presidency. Now, what if instead Mr. Trump ends up being the next president? Well, Mr. Trump has talked a lot about his ideas and proposals for increasing substantially expenditures on infrastructure projects. And by the way, Ms. Clinton has also proposed a lot of increases in infrastructure spending. The big difference is, in my opinion at least, if Ms. Clinton's elected, the Republican-controlled Congress, assuming they retain control of Congress, they're not going to pass laws to have a lot more spending on infrastructure projects. In contrast, my opinion is, if Mr. Trump is elected, there's a good chance that the Congress will pass such laws. And the reason being is because he's going to satisfy them substantially with his proposal for decreasing tax rates. So there's a good chance that infrastructure stocks, and one example would be Granite Construction, GVA, would perform very well under a Trump presidency. next. Regarding a little bit more specifically, stocks and how they might react to cuts in tax rates if that were to occur. Well, that would big cuts in tax rates would likely very positively impact consumer discretionary stocks, because if people, if they're not paying as much in taxes, well, they have more money to spend. And studies have shown, by the way, that people do tend to spend much of the money that they save from tax cuts, rather than, not that they don't save that money, they actually go out and spend it, is what I'm trying to say. So that would benefit a lot of consumer discretionary stocks. And one example would be Coach, the symbol's COH. And lastly, there's a good chance that if Trump is elected, that stocks in the personal defense and not military defense, but protecting ourselves against criminal acts, and also helping to protect the police against criminal acts, would be a stock such as Taser International that makes the stun guns, symbol TASR. I think there's a very good chance that all three of those stocks would perform very, very well under a Trump presidency. Okay, so how does the election tie in with what I do? And what is it that I do? What I do is I try to avoid the big downturns and help others to avoid the big downturns in the worldwide financial markets, to profit from the major upturns, and to invest in the right asset classes, sectors, and individual stocks at the right time. And I'm very, very confident that regardless who's elected, I'm going to be able to do that. I mean, I've done it for more than 15 years now. It's just a fact. I've avoided the big downturn during 2000 to towards the end of 2002. And as Nick said in introducing me in this webinar, I've been able to avoid all of the big downturns since then, and to participate and profit from the upturns. And how do I do that? And what does it have to do with who's elected? Well, what it has to do with who's elected is, once again, my opinion is, based on a lot of historical research, that if Ms. Clinton's elected, that and her proposals are implemented, that we're probably going to see the U.S. economy worsen, and that stocks are probably going to move sideways at best, and probably going to have a downward bias over the next few years. In contrast, if Trump is elected and his proposals are implemented, that we're probably going to see the economy perform well, and that stocks in general are going to move higher over the years ahead. And so how do I determine which asset classes and sectors and individual stocks to invest in during any point in time? And the way that I do so is from a very top-down approach. In other words, I look at what's going on in the overall economy, both here in the U.S. as well as in other major regions of the world, primarily the Eurozone, Japan, China, India, and Brazil. And then I use what my research is finding to then determine which sectors and industries to go into, and from there, which individual stocks to go into. So let's begin by the highest level of my top-down analysis, and that is a review and analysis of economic factors and developments. And what I look at, usually if you turn on broadcast TV and a lot of financial publications, you'll hear persons talk about GDP, gross domestic product, that is, personal income, personal spending, retail sales. Well, I look at those economic statistics. In fact, I review and analyze more than 100 economic statistics from around the globe on a regular basis. But I do not focus on those coincident economic indicators that I just mentioned: retail sales, personal spending, personal income, GDP. Coincident economic indicators. And what do I mean by that? They're not even really indicators. They're revealers, if you will. In other words, those statistics reveal what's happening in the economy at a point in time. Well, you don't make money in the financial markets by knowing what's happened in the past and what's happening right now. You need to be able to forecast with a high degree of accuracy what's likely to happen going forward. And therefore, I focus on leading economic indicators, such as indicators for the manufacturing sector of the economy, indicators for the housing sector of the economy. I also look at employment statistics, leading employment statistics, such as online postings of job advertisements. And we're going to put up some charts of these, if they're not already up, showing you how stock prices in general, as measured by the S&P 500 index, tend to perform relative to the direction that these economic statistics or indicators are going. And there's many other leading indicators that I use, and what I did way back in 1986, I looked at dozens of economic indicators and focused on the leading ones, and I determined the correlation between the readings on those indicators and the performance of stock prices. And then I took the indicators that were very, very accurate in forecasting the direction of stocks 6 to 18 months into the future. Beyond that, nothing was accurate, but 6 to 18 months in the future, very, very accurate. And I put all of those indicators into an algorithm, into a computer model. And so I've used that model since then. Quite honestly, for about the first 5, 6, 7 years, I didn't even trust what that model was telling me because it didn't seem to make sense. I mean, it would give me a buy signal when the economy was doing really, really horribly. And it would generally give a sell signal when the economy is doing very well, However, I found then over the ensuing years, well, wait a minute, this works. And by using this model, this is what enabled me personally and persons that have followed my recommendations to get out of the stock market completely during January 2000, to get back into the market between October and March, October 2002 and March of 2003, to get out again during September 2000, right before the big crash, to get back again only 3 weeks before stocks actually bottomed during March of 2009. So I use a very top-down approach to determining when to be in the market and when to be out of the market. I mean, I have found that it's not really, being successful in the financial markets is not really about, doesn't really have a lot to do with being successful in the upturns. That's important. You got to be in there making money during the upturns. But more important is to avoid these big downturns. If you can avoid the big downturns, you're way ahead of the game. So I have all these indicators that I look at and monitor on a regular basis. I have this model that weights differently these indicators and spits out a result telling me to be either in or out of the financial markets. And primarily I'm speaking about the stock market, but it also relates to the gold market, to the real estate market, but primarily the stock market. Then what I do is I have models that reveal to me what's actually going on in the markets. And I look primarily at certain sectors, the 10 major economic sectors. How are they performing? And how are stocks of companies that compose those sectors, how are they performing? And what I want to always find is that the performance, the actual performance of different sectors are doing what they should be doing during different stages of the business cycle. Meaning that industrial stocks, financial stocks, if my model is saying, hey, get out of the market, stocks are going to turn lower, the economy is going to perform poorly, well, I want to see financial stocks and industrial stocks actually start to move lower. So I use what's going on in the markets with my sector analysis. And we're putting up a chart of that that'll give you an idea of what I'm speaking about now. Next, after doing that, that leads me right into which individual companies I should be reviewing and analyzing. I mean, it tells me, should I be looking to get into financial stocks, technology stocks, energy stocks, consumer discretionary stocks, or should I be going into utility stocks? Okay, so let's take a look at some charts of stocks that had all of the criteria that I just went over. And these are charts of stocks that I either personally owned, or that I'd recommended to others. So let's go way back to 2004 and take a look at Intuitive Surgical, ISRG, a company that makes a robotic medical device. Well, at the time, this company was pretty much unheard of. Who's Intuitive Surgical? It's not a big known stock. Well, look at how it performed over the ensuing months and years after I purchased the stock. Huge, huge returns. It had all the criteria that I just mentioned. Let's move forward a bit to Baidu.com, symbols BIDU. Pretty much unheard of when I actually bought this stock and recommended it to others. I could tell you a story about that, but probably don't have time. So let's just take a look at the performance of the stock. Baidu.com, essentially the China or Chinese Google. It's an internet search engine in China, and it had all the criteria that I just went over. Look how it performed. Tremendous returns. Next, let's take a look at a more recent recommendation that I'd made a few years ago. IPG Photonics, symbols IPGP. Had all the criteria. Look at the returns on that stock in a relatively short period of time. Another one is Silicon Motion Technology, symbols SIMO. Silicon Motion Technology makes integrated circuits for these little thumb drives that I'm sure that all of you use, as well as other types of small computer disk, memory disk. You might not have heard of the company, but it makes integrated circuits for products that you actually use on a daily basis. And look at the performance that it's had over the past few years. Let's now move forward and take a look at two more recent examples. Ambarella, symbols AMBA, that I've actually been in and out of twice over the past few years. Ambarella makes integrated circuits for these motion cameras. You've probably heard of GoPro, but you may not have heard of Ambarella. Well, Ambarella is the company that makes the technology that goes into these GoPro cameras. And it's now making similar technology for all these drones, all these small drones. And look at how its stock has performed. And lastly, let's take a look at Mercado Libre. You might not have ever heard that before either. Well, what's Mercado Libre? It's South America's eBay, symbols MELI. South America's eBay, and really the entire Spanish-speaking, if you will, eBay. It's actually based in Argentina, even though it sells, there's more people in Brazil and other Spanish countries that probably lead to a lot of its sales and revenue growth. But that's just another company that had all the criteria that I just went over. Look how it's performed marvelously. So these are the types of stocks that I prefer to go into and to recommend to others, the ones that have all these criteria. And very briefly, I want to say something that we're not going to throw up charts on, but also I look at turnaround stocks. In other words, stocks of companies that have had a big downturn, usually because of a big downturn in the economy, but then we're seeing signs from a top-down analysis that the economy is going to start to improve, and that those types of companies and stocks will likely do well as a result. And there's several examples that I could give of that, but the focus is on these stocks that have the criteria that I mentioned. So once again, but we don't want to just look at these stocks first. We want to decide, should we be in or out of the markets? I mean, we want to limit our risk. We want to avoid the big downturns and only be in the markets when we have a lot of indicators telling us that economic growth is going to increase, and that companies in different sectors are going to do well before we go into the individual stocks. So the top-down analysis is very, very important. So regarding the upcoming election, what is all this research and analysis telling me? As far as my top-down analysis on economic factors and developments, on the performance of different sectors, And what's it all telling me? Which sectors and stocks should we likely go into under either a Clinton or a Trump presidency? And what it's telling me is this. First of all, it's telling me that if Clinton's elected, we're probably going to see stocks move in a sideways pattern, which they've been doing pretty much actually for over a year now. It's been rather volatile. We've had certain up periods, but down periods, overall sideways. We're probably going to continue to see that if Clinton's elected. And it's because of her economic proposals or lack thereof. Quite the contrary, if Trump is elected, I think there's a good chance that, first of all, we're going to have stocks sell off sharply because there's a lot of uncertainty, but also because, which also will relate to Clinton to some degree, that all of these economic indicators that I monitor and this sector performance model that I have is telling me that the U.S. economy is actually continuing to slow, that we're going to see a continued slowdown in the economy over the next several months. So therefore, if Clinton's elected, well, you're going to have these big institutional investors that are supporting Trump. They're going to tell you everything's fine, but remember, that's not what they really believe, or they wouldn't be making their allocations in the way that they are. The reason I'm pointing down that State Street Research confidence index that I showed you, that stocks may hold up for a few months, but the economy is probably going to continue to slow, and we're probably going to have a downward bias if Clinton's elected. Quite the contrary, if Trump's elected, we're probably going to have initial sharp sell-off because of a lot of uncertainty regarding a Trump presidency, and we might have stocks continue, to move sideways. Then after a sell-off, I shouldn't say continue, but move sideways for a few months off after a sell-off because of the weakening economic environment. But if Trump is elected and these primarily tax proposals, tax rate cuts, less government regulation, less spending on military conflicts abroad, we're probably going to see stocks bottom out early next year, and we're going to be able to go in and pick up some really, really fantastic stocks at really great values. So that's what all of this research is telling me, and how we should react to a Clinton or a Trump presidency. Okay, so let's wrap this all up. How did we start this off? We started this off by talking about the extreme importance of this upcoming election. And it is going to be a very, very important election, and it's going to have very substantial impact, in my opinion, on the economy and the financial markets. And hopefully you now have a better understanding how, at least my research and experience indicates, that who's in the White House this time around is going to be a big matter. Okay, well, I hope you've learned something today, and now I'm going to pass this off to our publisher, Nick Macchia.
Thanks, David. This was very informative, and I know we are all anxiously awaiting November 8th, if for no other reason than knowing we won't have to watch another single campaign ad for another 4 years. On a more serious note, for those of you who want to jumpstart your portfolio, no matter who wins the election, I've got some great news for you. As my way of saying thanks for joining us tonight for our pre-election Investor Summit, I'm going to give the first 100 folks who click on the bright button below a chance to try David Frazier's strategic allocator for the lowest price he's ever offered. And let me remind you, this special offer will not be repeated after this event. Be one of the first 100 to sign up tonight, and you will receive a 1-year subscription to David Frazier's Strategic Allocator, a monthly investment journal that'll help you stay abreast of significant developments in the worldwide financial markets, position your portfolio properly during different types of investment environments, and will help you communicate more intelligently with your financial advisor. In every issue of Frazier's Strategic Allocator, David provides recommendations and advice on 3 model portfolios: a conservative growth and income portfolio, a fixed income portfolio, and a speculative portfolio. Plus, as part of the service, you'll also get David Frazier's weekly investment commentary delivered via email, where David provides a weekly review and analysis of significant economic and financial market developments around the globe, as well as his near-term outlook for the worldwide financial markets. You'll also get trade alerts in between monthly issues whenever David issues a new buy or sell recommendation. You'll also get access to David's weekly internet TV show, Frazier's Market Insights, where he reviews major topics covered recently by the financial media and so-called Wall Street experts, and offer his views on the accuracy or lack thereof regarding comments made by those experts. Plus, you'll also get a free bonus report, Boom or Bust, your post-election investment guide, where David reveals even more about the stocks and sectors he talked about today, including 5 additional stocks he is recommending no matter who's elected president. And here's the best part. You get all of this for the low price of just $279. That's almost half off the regular price of $550. Plus, it comes with a 100% money-back guarantee for the first 30 days. And you can have it in your hands as soon as tonight. All you need to do is be one of the first 100 people to click on the bright button below or call 1-800-393-1706 and try the Frazier Allocator. I'm so confident it'll boost your portfolio that it comes with a 100% money-back guarantee for the first 30 days. Try it risk-free for the first 30 days, and if for any reason you aren't happy, just let us know and we'll promptly refund every penny. Okay, we only have a few minutes left, and I can see that more than half of the memberships are already gone. There's just 36 left, it looks like, so please act now and click on the bright button below or call 1-800-393-1706 now before you miss out on this incredible, never-to-be-repeated opportunity. Remember, this special offer expires in 24 hours and will not be repeated. To take advantage of this limited time offer to save $271, just click on the bright button below or call 1-800-393-1706. Thanks again for joining us, and make sure to vote on November 8th.